Dangote Cement, good results, yet they were below expectations and management's forecasts. Now, analysts say we may see a downward revision when it comes to their 2012 forecasts. Even with increased capacity, we saw the company come on with this year. What's your take exactly in terms of their forecasts?
Well, I think the thing with Dangote Cement and in fact with Lafarge, the cement industry in general, is that yes, there has been significant capacity uplift from both DCP and from Lafarge, but the challenge has been with regard to utilization, ramping up utilization, and also the nature of the fuel sources that are used to sort of execute the production process. So the challenge really has been with gas. A lot of the margin estimates for the cement companies was predicated on a very high gas usage at very attractive rates that have been secured. However, there's been a shortage of gas supply, at the right pressures, which has meant that producers have had to use LPFO, which is a more expensive fuel source, and much of that imported LPFO, which is even more expensive. So that has squeezed margins, and that has therefore had a negative effect on earnings growth relative to expectations.
Well, what's your take on Lafarge Wapco? I mean, there's been a lot of comparison between Dangote Cement and Lafarge Wapco. And I mean, looking at Lafarge results, we saw sales up 55%, PBT up 145%. In fact, analysts are saying we see 2012 forecasts being revised upwards. What's your take on Lafarge as compared to Dangote Cement?
Well, Lafarge Wapco right now is our top pick in the sector, simply because we see more upside in terms of the impact of the new capacity on their performance. I think that as far as the gas usage is concerned, perhaps Dangote is slightly more vulnerable overall, and so I think that Dangote has been the headline stock in the sector for some time, and I think in the recent past maybe a bit less attention has been paid to Lafarge. So we have a target price of 60 naira on Lafarge, which is upside of around 45% from current levels, vis-a-vis a much more modest upside at DCP of just 23%, with our target price of 145. However, over the medium term, given the sheer dominance of Dangote in terms of capacity and its share of market, we would still expect it to do very well, over the medium term. But in the immediate, we feel that there's more upside in the short term from Lafarge Wapco.
Well, really, what about UACN? They also came out with results yesterday on the Nigerian Stock Exchange. And looking at the results, certainly the restructuring of their core businesses is a good thing for them. Now, you anticipated its Q2 operating earnings would come in flat and maybe lower in Q2 2011. Certainly that wasn't the case. Now, any changes to your expectations in that stock?
Well, UACN has been our top pick in the consumer sector for a while, on the basis that, clearly it is a restructuring story, and there's a bit less visibility on its business, in the next couple of years, vis-a-vis a more sort of vanilla operation like a Nestle. But that's also in the price. So we feel that the market has yet to fully price in or digest the potential upside from the reorganization of its business, the JV with Tiger Brands and so on. And we think that certainly as far as the first half results were concerned, it appears that UACN was better able to contain input costs than we had anticipated. So on the face of it, the results look strong. Of course, they have a conference call today, which ought to give more insight into the drivers of the business, and I guess we will revise our models and our expectations once we have had more detail from management. But certainly we were comfortable with the results, and for the moment it remains our top pick in the sector.
Well, really, let's look at the market performance and going forward, what your outlook is for the market. We know certainly we had a great start to the month, but especially in the banking sector, what is your outlook? I mean, we've had the CBN and the MPC come out with certain directives that analysts see impacting the banking sector negatively in the long run, such as the increase in the CRR. We saw them say announce a reduced NOPL. They also said they cannot recapitalize offshore units without funds from home. They also barred banks from accessing the WDAS window, while they were also accessing the standard lending facility transactions with the CBN. So what is your outlook for the banking sector as we go forward?
Well, in truth, we have, whilst actually we have all of our names under coverage on buy on account of the very deep discounts that exist within the sector, we have always said to clients that we are far more comfortable with the sort of larger banks at this stage, and that our view on the smaller banks is slightly more speculative because they're less shock absorbent than the bigger banks, and we still maintain that case. I mean, if you consider CRR, for example, which is probably the most significant of the steps that was taken by the central bank, the motivation for that is to of course, as we know, support the currency, which is a concern in an environment where the oil price outlook looks more vulnerable than it was, say, a year ago. But the larger banks that have this natural sort of advantage with regard to cheap funding, yes, their margins will be squeezed somewhat, but these are the guys who are net placers in the interbank market and have been able to generate earnings year on year, earnings growth year on year by placing in the interbank at higher rates and by also placing money in higher yielding treasury bills. This will constrain them a little bit, but only a little bit. In terms of the adjustment on their loan book growth, for instance, I think that there was already a relatively relaxed view on loan growth for the year, and this may make them relax a little bit more. But I don't think that the top three, the likes of Zenith, First Bank, GT, for instance, are going to be particularly adversely affected by this measure in and of itself. I think perhaps the smaller banks, the likes of, say, Sky or FCMB or even Diamond, are likely to be more vulnerable because they are probably more keen to grow loans and are less likely to have the liquidity surpluses to the extent that the larger banks have them. So we'll have to see the extent to which those names are affected in the second half. But I think that the top tier banks, in particular those that don't have any integration concerns, we're still comfortable with those names.
Well, Rele, I'd like to find out what sectors do you see stepping up? I mean, you've mentioned the banking sector certainly is still going to be sort of in the forefront in the second half of the year. What other sectors do you see stepping up in the second half of this year and, of course, during the course of August? And give me some of your stock picks as well.
Well, I mean, I think that 2012 was always going to be a banking sector story, to be honest. So I think that anybody who is putting money to work in this market on a value basis, given the cycle, it has plenty of incentive to weight their exposure towards banks. However, we also quite like the cement sector because we feel that demand is still well underpinned. And despite the challenges with gas and the impact that may well have on margins, we're still talking about a relatively healthy margin environment for these guys. I mean, demand is robust, capacity is now local, the margins are better. So we're looking at EBITDA margins of 37% for Lafarge Wapco, 57% for Dangote Cement versus 23% for their international peer group, and we expect that this will be sustained pretty much through the year. Now we do have some concerns in the second half with regard to outages and obviously how this fuel situation plays out, but we still think that the cement sector will perform well.